Hi everyone, welcome to beginner's class from Zen Trading. My name is Ronnie. I work full time as a trader, also mentor trading as well, which is primarily for the U.S. markets, but I will bring in the Canadian during this chat as well. Again, this class is an introductory class to beginners, so this would be a good time for you to kind of get an idea of what traders do full time, what we look at, the importance of things, some of the terminology, and some of the choices that you have and some of the things that you need to be a trader and resources for them. So I'm going to first start out with the chart. Traders use charts. We use charts to give us information that most of the market participants have already priced it in, and it comes out on the chart. So one of the criteria that we look for, besides using a chart, is we're going to buy quality items. And I'm just going to go through a list of what we look for quality. And for the most part, this is what fund managers, also known as institutional traders, that's what they screen for. That's what they buy. That's what they favor. And those are the guys that you need to keep the prices rising as you take position in trade. Okay? So I'm going to get started as far as quality. Quality investment really is, for the most part, the largest companies in the US and specifically in the technology sector. So for the most part, 10 companies that are tech stocks, they make up half of the buying of institutions. So I'm going to go over those 10 companies right now so you have some idea what most of the money today is going towards. And it's going to be very self-evident as far as why these 10 companies attract most of the money, not just locally, but also globally. There's a global appeal to these 10. So the first one you might know is the largest company. It is Microsoft. And the way they assess companies is by size. It's a term that's called capitalization. Capitalization is the value of a company, so much it's worth. Price of the share multiplied by how many shares was created when it first started. Appeared. So let's get right into this. Microsoft is a $3.4 trillion company. So it would be one on the hit list. Second one is NVIDIA, Apple, Amazon, Google, Meta, also known as Facebook, Tesla, Broadcom. There's also Walmart. There's also another Google, which is a different class shares, as Google Alphabet, Netflix, and so for the most part, those are going to be the ones that fund managers, they're always going to be looking to buy. They're going to buy them on the dips. And they're so popular that they created an index. The symbol for that index is QQQ, also known as the NASDAQ 100 index. NASDAQ is just an exchange where they trade. There's a list, kind of who governs all the companies in the types that especially. So the QQQ index, when you buy this thing, you're buying 100 of the largest companies. 10 of them represent half the value. 10 of them represent half the value. So they're not equally weighted. Give you a little better insight to what QQQ is. This is on Yahoo Finance. So you can see these are the top 10 holders. Apple, Microsoft, NVIDIA, Amazon, Broadcom, Meta, Netflix, Costco, Tesla, and Google as well. Here's the percent assets. The value is the weighting of the index. If you add up all of these numbers, you get 49%. What does that mean? It means that this value, QQQ, this index, this 100 stock index, this value of 521.55, what we closed at today, almost half of that value is just from 10 stocks. Kind of like your exam, these are the biggest weighted marks. They contribute to a big part of your passing grade. Here's the sector breakdown on the right side of this index. Sector just means it's what's inside, major components, the major areas of study. So as you can see, technology, it's 51%. So of these 100 companies that's in this index here, QQQ, half of them are technology stocks. And then there's a further breakdown of the rest, 15% communication services, retail, and so on and so on. For the most part, there are no energy stocks and there are no financials in this one. It's purely tech. Okay? Financials and energies are considered value stocks. They're the oldest sectors, the older industries. Apparently, nobody wants them. So this is one of the reasons why they're not included in the thing. Right? So you will not find any financial companies like banks or energy companies in the six. It's purely high growth tech industry. Okay, so let's move forward. Let's do a comparison of this index compared to other indexes that you might know. For example, the Standard Poor's 500 index, which is pretty much the same thing, but just a broader index. It's 500 companies, and that's quoted almost every day in the news. For example, CNBC, they would be one news channel that would be quoting prices of Standard Poor's 500. If you look at CNBC right now, for example, when you look on the indexes, they'll tell you, the futures are down. For example, these are futures traders and prices. Okay. And that's one of the things why 74500 index would be another index to look at. In Canada here, we have our own version of it, the Canadian version, the best companies, and that would be the TSX 60. So this would have the 60 best companies in Canada. Again, these would be big cap stocks, big name stocks. So these would be stocks that you would know. For example, for the Canadian side, some of the companies that would be included in the index would be Royal Bank, TD Bank, Nova Scotia, Canadian National Railway, Suncor. So you kind of get, yeah, these are big name stocks, Enbridge. Okay. So the 60 largest companies make up the TSX 60, which is the Canadian version of quality companies, and they would be rival to the US. So one of the things that I had to do is I had to do a comparison of these indexes that represent the best companies of that country and see what it is. I did a little 15-year study. So I'm going to share it with you so you get some idea where your money should be just from a performance point of view. Okay, so let's go with the triple Q first. So if I do a 15-year study on this, I'm going to go 15 years, and I'm going to show you what the performance is. So this software has the ability to do studies. It has the ability to take a long term, and it can tell you what the performance is over that period of time. Okay, so let's say we did a 15-year study from May 20th, 2010 to May 19th, 2025, pretty much today. 1043%, 1,043% is the performance for triple Q. It's how that index performed. So if you had a share of triple Q, right, on 15 years ago, that would be the return of it, from it. Okay, we'll do one for SPY, keep that number 9. SPY, we do the same thing, the same comparison for the same amount of time, you would get 476%. So triple Q clearly, it's about at least twice as much performance than SPY. Okay, that's just to give you some idea. And then of course we'll do the last comparison, which is the TSX 60, with the same time frame, keep it consistent, and that's 130%. So I'm going to say I would encourage you to invest first of all in US stock indexes, not Canadian, because of the performance difference. And if you can, I would prefer triple Q more so than SPY because of that performance. So we pretty much have best index to look at, triple Q, and the companies within that, which are the top 10 companies in the world by size. And I'm going to say just demand. There's a lot of people who want to buy these individual stocks globally as well. Okay. So that is a quick rundown as far as some of the options that you have and how you can trade them. So if you want to buy triple Q, it's really simple. Just go to your broker, you put in the symbol, 3Qs, you buy 100 shares. Okay. So you buy 100 shares, you pay $521.50. This is US dollars, and that would be your investment. Now let's talk about the second part, which is protecting your investment. One of the things they don't really talk about in a lot of seminars and things online is they don't talk about risk. They talk about risk management, but they really don't tell you manage risk, but they're not specific how. They don't tell you how. So I'm going to show you how it can be done. So you can actually buy insurance on these shares, just like what you have in car insurance. You can buy the same thing. You can buy protection for this. Okay, I'm going to give you an example of what that would be. So let's say you paid 521.49 for it. You could actually sell it for the same price. So over here on the left side, the insurance, they call it puts. They have dates on it. So for example, this one's June 20th, right? So insurance has a time frame. It's not forever. There's a specific time, June 20th, Friday, 4 p.m. Eastern time. Okay, that would be the end of your insurance coverage. It's like any other coverage that you'd buy. So Friday, 4 p.m. Eastern time. So insurance would run out. So the insurance on this would be really simple. You'd be able to sell it for one of these numbers on the left side. So let's see, we bought for 521.50. If I look here, this is a number here, 521. And this number here, 1120, would be guaranteed to get this insurance. And this is per share. So it's 1120 per share. That's the cost to insure one share. Okay? It's only one share. The way they quote insurance is on a per share basis. Okay? So 1120. $11.20 per share. That's a coverage, the amount of money you need to insure one share. So if that share goes to $1, doesn't matter. You get $11. You get $521 for it. Okay, so this is insurance coverage 521. What does that mean? It means that you get to sell your shares for 521 no matter what happens. You get to sell your shares for 521 US dollars, no matter what happens. So let's say you had a nuclear war tomorrow. Okay. This QQQ here might go down to $1, like everything else in the world will become almost worthless in a nuclear war. So you wouldn't have to sell it for $1 like everyone else. You would be able to sell it for 521. That's what insurance is, full coverage insurance. Okay. So because you want insurance for 100 shares, right? You will be paying 100 times 1120. So that would be 1120 US. That would be your full coverage, your full cost to protect all 100 shares, 1120 US. Okay. So that is full coverage insurance. It means you can sleep at night. You don't have to worry what's in the news. You don't have to watch it. Full cover insurance on for June 20th, Friday, 4 p.m. Eastern time. So this is the beauty of trading. You actually have insurance on almost, say, 3,000 items. And 700 of those are probably the most in demand, like big cap stocks, for example. So you can have insurance on a stock, you can have insurance on an index. Okay, so this works very well for people who don't want to worry about their account. Okay, so let's say you had $1 million account. Triple Q, and like all the other markets, they go down as much as 20 to 25%. For example, Triple Q went down 23%, just like all the other indexes, and in just a very short time frame, maybe 6 months. So let me just tell you what was on the news in the last 6 weeks. We're connected, you know what's going on, and that is the effect, the negative effect of what can happen. So if you take a 22% hit on $1 million, that'd be 220 US, 320,000 US. That's what you take without insurance. Whereas if you were to buy insurance, let's see, you buy about 2,000 shares, typically, approximately, it's $1 million. You need 20 of these puts. Each put, just a reminder, it covers 100 shares. As I mentioned before, one put covers 100 shares worth of insurance. So if you have 2,000 shares, you will need 20 puts. Okay, so we did a value here already. It's 1120 US for one put. So it'd be 20 puts times this number. So that would be about 22,000 US. So you can see this number is a lot smaller than this one. Not the same thing. You lose your insurance money, you do not get that back. Insurance is not refundable. You don't have that deal anywhere in this world. So you definitely lose 22,000 US. But you would not lose 220 US, 220,000 US should you sell it, or should you need to sell it, should you panic and sell it. And that's the beauty of insurance. When we do our class for beginners at Zen Trading, we teach this principle first. You cannot trade without insurance. You're not allowed to in class. It's not what we do because it is the only way we can manage the risk at any time. Okay, so this is something that I encourage you to do. Find out about put insurance, apply to do your simulated trades like what we do in class here, Zen Trading. And that is the biggest part of risk management, and the only really part that you really need to do every time is buying insurance for your investments. So in this remaining, I'd say about a couple other items I just want to talk about, and that would be price. Okay, so you have some idea of quality. We buy quality stocks, that would be the big cap stocks, all your name stocks, Walmart, Costco, the ones that I've mentioned before, especially those 10 big cap tech stocks. Okay, those would be the ones I would be focused on, these guys here. Okay, that's what I would be buying in my portfolio with insurance. Okay, if you can, even better, buy the index that has them. Right, that'd be QQQ, and buy insurance and QQQ as well. Okay, I'm going to do one stock example with insurance, so you have some idea that it also works with stock. This is just an example of an index. Let's say I bought Apple. Okay, if I buy 100 shares of Apple and I want to insure it, okay, Apple today is trading at 208 US. Okay, closing price today. So I want to insure it for 208 US. So what does that mean? It means that because I paid 208 US for it, I want to sell it for 208 US. Again, here's the insurance stream here. Those puts, that's what the insurance is called. There's a date of insurance. It's how long the insurance is good for, how long it lasts, same thing like QQQ. And we're gonna go down here, which is the values as far as the amount that you want to insure it for. So here I'd say 217.50. That's pretty close to 218.23. The closest number I can find. So that's insurance I would pick and buy. 217.50 is the coverage I would get. And the cost of that, as said before, it's quoted on a per share basis. So if you look here, the largest number here is 1160. That means it's guaranteed that you will get that number. Okay, the other numbers are when you negotiate. I don't negotiate insurance, it's not what I do. Okay, so 1160 would be the rate. Put it right here for you. $11.60, as I said before, this is per share. You got 100 of them. You got to buy 100. This number, the cost will be 100 times this, which would be 1160. Just a reminder again, one put does cover 100 shares. Okay, so it's not 100 puts for 100 shares. It's not like that. Okay, one put is 100 share worth coverage of insurance. Okay, so this is at 1160 US for the total for the insurance. All right, and then that way, the most you can lose on Apple is 1160 US from today till June 20th. There's an end date here for where the coverage ends, it finishes. It's like any other coverage. It's 20th, Friday, 4th, 1 Eastern. So what's the benefit of this? It means that if Apple goes to, I don't know, $5, it drops $200 tomorrow if it's fraud or something. Everyone will be selling their shares for $5. You will be getting for your shares, all 100, you'll be getting what your insurance covers for. It's $217.50. It's a very cool way. You're 100 protected on the capital investment, the biggest monies that you have. You will not be refunded the insurance money, and you do have to pay for that up front, just like any other insurance policy that you take out as opposed to like your car or your house. It's the same way. Okay. But the nice thing is it is available. So if something really bad happens in the stock market, right? You will not be worrying, praying, guessing, hoping. You know what I mean? You won't have that experience. You can sleep at night. Okay. Tell your wife that you're not losing money. It's my favorite. You don't have to lie about it. All right. So the last part, besides covering quality stocks, covering indexes, quality indexes, covering the performance of the best indexes, covering insurance. The last part, we're just going to talk about what traders and everyone looks at, and that's price. So for price, traders presently use candlestick charts. Okay, so the candlestick charts are these guys here. For the most part, I'd say they're easy because they're very visual. So these candles, very simple. It's empty. It's kind of like a balloon. When you first release the balloon at a certain amount of time, the beginning, say 9:30 in the morning, by 4 o'clock, it's going to go here because it's empty. So all of these empty balloons are going to be higher at the end of the day. Okay, so it represents price. So price starts at the bottom of the balloon and finishes at the top. Okay, so you got candlestick charts, but they kind of look like balloons. So prices start at the bottom of the candle and they finish the top of the candle. Okay. For the solid ones, they're like solid balloons that are like kind of like balloons filled with water. So they're gonna start at the top, the beginning, that'll be 9:30 in the morning, opening price, and they're gonna finish at the bottom. Okay. So if you see a lot of charts with falling prices, okay, they're gonna look like filled balloons, like this guy, where the prices they just they're always filled. So it's not the color, it's more of what the body has, the color of the body. So if it's solid, see a lot of solid bodies, that means it's falling. And on the flip side, if you see a lot of empty bodies, these guys here, like the balloons, it means that prices are rising. So very, very easily, quickly, you can tell whether something is falling or not. These are Japanese candlesticks, and it's what they used at the 1600 to trade rice futures. I'm going to show you the difference between Japanese candlestick charts and what we call Western bar charts. What Western traders use, for the most part, those are US traders. Okay? So those charts are what we call line charts or bar charts. So the difference. So those charts are basically lines that has a open, close, and a high price. So the first one that was created was HLC bars. It's called an HLC bar because it had a high, which is the highest price, a low, L, which is the lowest price, and a closing price, end of the day price, 4 p.m. price, that thing, price before everyone goes home, closing price. But then the traders wanted to know where they started from. They wanted to know the opening price. So this bar chart, this Western bar chart, evolved into a OHLC bar. The O stands for the opening, and that is on this side. Opening, 9:30 a.m. where you begin that thing. Okay, so that's this price here, where this line is. Okay, so this is the opening, this is the close, high end, and this is the low. Well, you can see if I look on this chart, for me, this is a lot harder. I can't tell from these lines, these bar charts, what the trend is. It's harder for me because they're just lines. I just don't see it. I'm not able to use these with my advantage. The candlestick charts, I'm going to change this candlestick so you can see the difference. As soon as I see these empty bodies and the consistency of them and the direction of them and the trend of them, it's very evident to me whether this is an uptrend or a downtrend. So if I look on, say, QQQ, I can see that we're in a downtrend because this area has a lot of solid bodies, filled balloons, these guys here. But suddenly there's a shift where they become empty and they're also rising. So QQQ is an uptrend here and it is in a downtrend here. So you can kind of get an idea also when there is a change in trend. That finishes us off today's class, and today's, I want to say, first presentation. Hope you enjoyed it. Hope you'll join us for more. And at this point in time, I wish you all the best in your training.